Sanctions are economic and political measures that a country or a group of countries impose on another to influence its behavior. They can include trade restrictions, financial penalties, and travel bans, aiming to pressurize a change in the sanctioned country's policies or actions. Sanctions affect international trade in a big way, and especially financial sanctions affect banks because it prohibits them to send or receive funds from the sanctioned individual, entity, or the country. Let's quickly learn a few important points about sanctions. Sanctions can be imposed to prevent financing of terrorism, to politically pressurize a country, or maybe to safeguard international peace and security. It can be imposed by a specific country or by a supranational organization like the United Nations. The current list of the sanctioned countries by the UN is available here. Banks are subject to sanctions to the extent their laws specify. So, all international transactions must undergo sanction screening to identify if that transaction is dealing with any sanctioned entity. Sanctions rule override other internationally accepted rules. For example, the ICC rules used for international trade. For example, if a letter of credit transaction involves a sanctioned country, then the sanction rule will override the UCP 600 rules. As you can understand that this can lead to serious issues in conducting international trade. ICC has published a guidance paper about how to handle sanction clauses in trade finance instruments like letter of credit. Thus, you should always be very careful in screening for sanctions while handling international trade, as evasion of sanction rules can result in very serious consequences for the bank involved, like fines reaching millions and billions of dollars for violation, legal issues, and reputational damage.